Well, let's turn to the markets in the United States now, where stocks are setting up for more losses, with the S&P 500 index facing its worst weekly performance since November as U.S.-North Korea tensions take a toll on investor spirits. VOA Channels TV financial correspondent Jill Malandrino joins us now to tell us more about the markets this week. Jill, do you think the volatility this week was more due to saber rattling between the U.S. and North Korea, or just a classic summer sell-off?
North Korea earlier on Thursday outlined details for a missile strike near the U.S. territory of Guam, adding fuel to rising tensions with the United States. The response was met with more saber-rattling late afternoon as President Trump said North Korea should get their act together or it will be in trouble, quotes. And we also saw just on Twitter earlier this morning around the 8 o'clock hour that he has stepped up that rhetoric. Markets have slipped further on Trump's retort. And again, this morning we're seeing the futures lower. Flight to safety continued for a third day on Thursday as stocks dropped across the board, with technology and small caps underperforming, while bonds and gold prices advanced to safe haven assets. Major averages bring their losing streak to 3 days now as a round of mixed retail earnings coupled with geopolitical fears weigh further on sentiment. We have not seen these levels since May. Technicals also played a factor as the S&P 500 index traded to its 50-day moving average support of 2448. That's a level we haven't tested since early July, while the Nasdaq crashed below its 50-day moving average support of 6271.
Now, having seen all this, should investors be overly concerned?
Well, certainly the threat of nuclear war is cause for concern. Despite the rhetoric, we hope for cooler minds to prevail. I think if the threat was really real, you would see a massive, massive sell-off, not just a 1% pullback. Actually, we're about 2% from the highs right now. Even the bond market is not reacting like a nuclear war is imminent. Though the markets were spooked by tensions with North Korea, one set of stocks relatively outperformed as expected. Aerospace and defense names like Lockheed Martin, General Dynamics, and Raytheon, they all moved higher. Some of the worst performers, on the other hand, they were in the financial sector, which conceivably could come under pressure if concerns about international tensions continue to propel bond prices higher. But we really haven't seen that massive move with bonds. Banks typically benefit from lower bond prices accompanied by rising yields. Keep in mind that the equity markets, we still remain near all-time highs. As much as investors might want to see the market go straight up, there has to be some down days sprinkled in with that. That's a healthy thing. It could be time to buy some stocks on sale if we see cooler heads prevail and less rhetoric with North Korea.
But aside from what we've seen this week, do you think the year 2017 has been calmer than anyone ever expected?
That's an understatement, especially in the face of a chaotic administration in the White House and a lack of clarity with policy. Typically, stock markets do not respond well to uncertainty. 2017 has thus far proven to be one that has virtually ignored technical and fundamental patterns as the nearly decade-long bull market rages on. If you look at a 10-year chart, this past couple days is just a blip. You can't even really discern the line on it. Prior to North Korea rhetoric, the S&P 500 not closed more than 30 basis points up or down for a record 15 consecutive trading days, to the frustration of traders. Certainly, this type of tranquility cannot go on forever, and many analysts expect an uptick of volatility over the remainder of the year. Undoubtedly, the question now is, has the market finally had a trend change, or is a blip on the bull's radar? As always, it is wise not to top and bottom tick the markets. There will be plenty of opportunity if there is a trend change. In fact, if the composure of the market changes, you just have to take what the market gives you right now.
VOA Channels TV financial correspondent Jill Malandrino, many thanks for these updates.
Thank you.
And the markets in Asia are not left out of the aftermath of the rise in geopolitical tensions this week, as shares closed at their lowest in nearly 3 weeks on Friday after investors fled to safer assets. The S&P ASX 200 index fell 1.2% to 5,693.1 at the close of trade for a weekly loss of 0.5%. South Korean shares ended at an 11-week low as anxious offshore investors sold stocks following Trump's fresh warning. The Korea Composite Stock Price Index closed down 1.7%, and that's its lowest closing level since May the 24th. Crude futures are firmly lower today, weighed by continued oversupply concerns after the International Energy Agency said oil production will continue to increase in July. Escalating tensions between North Korea and the U.S. are also keeping oil traders nervous. Brent crude futures eased 0.3% to $51.73 per barrel in early trade, Well, the losses follow a sell-off from Thursday's session when the monthly oil report from the Organization of the Petroleum Exporting Countries said the cartel's July production rose 0.5% from June to 32.9 million barrels a day. Well, that trend was further confirmed in today's report from Paris-based IEA, which says crude output from OPEC climbed by 230,000 barrels a day in July to a new 2017 high of 32.84 million barrels a day. Globally, supply rose by 520,000 barrels a day last month to 98.16 million barrels a day, making a third consecutive month of increases. In the meantime, gold prices held steady after touching their highest in over 2 months today, and they're on track for a weekly gain boosted by rising tensions between the U.S. and North Korea, which triggered safe haven buying. Spot gold was nearly flat at $1,285.76 an ounce in early trade and was set for a weekly gain of over 2%. U.S. gold futures for December delivery rose 0.2% to $1,291.80 an ounce. Away from the markets now, the Brazilian economy may be on the path of recovery from a recession, but the central bank says the rates are inevitable despite a stronger job market. The president of the Central Bank of Brazil says the rapid drop in interest rates from 14.25% in October has already been stimulating economic growth.
Although the Brazilian economy appears to have recovered faster than expected after a deep recession, the central bank says that should not prevent it from cutting interest rates in coming months. According to the Labor Ministry, Brazil's economy has added about 100,000 jobs so far this year. The 2015-2016 recession cost Brazil nearly 3 million jobs.
Ele é o último indicador a melhorar. Eu acho que ele está vindo pouquinho mais rápido.
Generally, the job market is usually the last to improve, but that is happening slightly faster than we thought. First, I thought we'd see the GDP, consumption, investments returning, and the labor market after. The labor market is coming along a little faster. It always starts by creating informal jobs, and then later come jobs on the formal market.
The bank signaled last week in the minutes of its latest meeting that it was likely to slash the benchmark Selic rate by an additional 100 basis points in September to 8.25%. Economists expect the bank to cut the Selic rate further to 7.5% by the end of the year. But Mr. Goldfund says the rapid drop in interest rates from 14.25% in October has already been stimulating economic growth.
Business Incorporated returns in just a moment. Please stay with us.